All right, so for part 3 of chapter 10, we are starting out with what do we do to get rid of an asset when it's time? So whether it's disposing it and, selling it or just getting rid of it. All right, so when we look at this, we have one thing that we have to do that's really important. So before we can get rid of any assets, we have to make sure that we've depreciated up to the date of disposal. So we want to record every depreciation that we can. And the reason is because we need to have an accurate book value. Remember, depreciation updates the book value, so then we can determine what we need to have to break even, what we would need to have a gain, or if we're taking a loss. So to dispose of an asset, we have a journal entry that we're going to be doing. The first part is to determine whether you're receiving cash or if you're paying out cash. And sometimes you might have to pay to get rid of an asset, so that is totally possible. The other part is we're going to have to look to see if we have a gain or a loss and record that. So those are things that are, optional that could happen in the situation. But anytime you're disposing of an asset, the middle two things, removing accumulated depreciation and removing the asset cost, are going to be what we're going to do every time. So we're not just removing the asset from the books, we're also removing that accumulated depreciation that went along with it. So accumulated depreciation has a credit balance, so to remove it, we're going to debit. Our asset has a debit balance, so to remove it, we're going to credit the asset. And then we have to look at some other factors to determine if we're getting money, if we have to pay out money, if we have a gain, or if we have a loss. So let's look at how we can determine whether we have a gain or a loss. So this slide shows us that if the cash we receive is greater than book value, we're going to record a gain. If the cash we receive is less than book value, then we would have a loss. And if it's equal to book value, there's no gain or no loss. So if we have a gain or a loss, again, a gain is recorded with it's going to be a gain on the disposal of plant assets. If it's a loss, it's a debit on the loss of disposal of plant assets. So we're going to record the cash if we receive it as a debit. If we had to pay it out, it's a credit. So rules of cash stay the same. And let's look at an example to kind of put this into perspective a little bit. But okay, let me go back one more time. This slide here would be one that I would maybe take a picture of so you have it, pretty handy, because it does tell you the entries you need to do and it helps you to recognize gains and losses. So keep that slide handy. All right. The next one is going to be an example, and it says a machine costing $9,000, which had accumulated depreciation of $9,000 on December 31st of the previous year, was discarded June 5th. So we fully depreciated it. There's no salvage value. We're not selling it. We're just getting rid of it. It served its purpose for our company. We're done with it. We're getting rid of it. We're not getting any money for it. So we have to remove the asset from the books. Since the asset has a debit balance, we're going to credit the asset. This case is machinery for $9,000. And we have to remove that accumulated depreciation account too. Remember, we don't want one left on the books without the other. They are co-accounts, so they go together. So you have to, if you remove one, you're removing the other. So accumulated depreciation has a credit balance, so we're going to remove it by debiting it. So that's what the entry would look like if you were just getting rid of the equipment or the machinery and you're not getting any cash for it, and there's no gain or loss because you're not getting any cash that you have to even consider. You're just getting rid of the asset and it's fully depreciated. If it's not fully depreciated, you could potentially have a loss, and that's what we'll look at in the next one. So this is an example of a fully depreciated asset being removed and gotten rid of or discarded. If we have an asset that's not fully depreciated. So this example says the equipment cost $8,000 with accumulated depreciation of $6,000 on 12/31, and it was discarded on 7/1. So they use straight line depreciation over 8 years with a zero salvage value. So that means they have 8,000 divided by 8 years. because there's zero salvage value. So 8,000 minus 0 divided by 8 gives us $1,000 per year that they are depreciating. Now, this, it says it was discarded as of 7/1, right? So that's halfway through the year. So the first thing we have to always do is bring our depreciation up to date. Make sure that we record depreciation up through that full time. So on July 1st, we need to record the depreciation from January to July 1st. They've already recorded accumulated through 12/31 of the previous year, but we haven't recorded anything from January to July. So we have January through June, a full 6 months that we're going to depreciate. So it's $1,000 per month, and I'm sorry, it's $1,000 per year, and we are depreciating for 6 of the 12 months. So we're taking that $1,000 for the year times 6 out of 12 months, because we're depreciating just 6 months of it. We're getting rid of it as of 7/1, so that's all we have to depreciate. So we have 1,000 times 6 over 12. And we're going to record that depreciation, bring it up to date by debiting depreciation expense and crediting accumulated depreciation. That's going to be our first step. Always remember bringing the depreciation up to date. Then we can actually get rid of the asset. So we see here that the equipment costs $8,000, so we're going to take the equipment off for $8,000. We had accumulated depreciation of $6,000 from 12/31 plus an additional $500 that we just recorded. So a total accumulated depreciation is $6,500. So if we're removing that, the difference is $1,500. Since we're not getting cash for it, we're losing that $1,500. So that's a loss on the disposal of equipment. So the cash we're receiving is 0. So if we go back to that slide that I told you to keep handy, cash is 0. Our book value is $1,500. So if cash is less than book value, cash is 0, book value is $1,500, we record it as a loss. So our entry, we're going to record a loss, a debit to loss on the disposal, where there's no cash changing hands, so we don't have that part. We have a debit to accumulated depreciation and a credit to the asset. So let's go back and look at that entry. We have a debit to accumulated depreciation for the $6,500 that we've accumulated so far. We're removing the asset of equipment by crediting it for the $8,000 cost. And the loss is the difference between the two, the book value that we're not getting anything for. So that's a loss on the disposal of equipment for $1,500. So those are examples if you're just discarding it. You're not selling it, you're not getting any cash, so you're just discarding it. So now let's look at some examples as if we are selling it instead of just getting rid of it. So our first example, it says that on 3/31, BTO sells equipment that originally cost $16,000 and it has accumulated depreciation as of 12/31 of the prior year. They use straight line depreciation, which is $4,000 per year, and they're telling us that the equipment is sold on 3/31 for $3,000 cash. So we're getting cash. We have to figure out what is the book value. But our first step is to update that depreciation. So we have from January to March, January, February, March. So we have 3 months that we have to record depreciation for. They told us that it's $4,000 per year, so we don't have to calculate how much depreciation was. So we take $4,000 per year times 3 out of 12 months that we're depreciating for, and we get $1,000. So we're going to debit depreciation expense for $1,000, credit accumulated depreciation for $1,000. And that means that our total accumulated depreciation went from $12,000 to $13,000. So what would our book value be? Our book value is going to be that cost, $16,000, minus accumulated depreciation of $13,000. So our book value is $3,000. All right, they told us that we're selling it for $3,000 cash. We're selling it at book value. All right, so if our cash we're getting is $3,000 and our book value is $3,000, then they equal. So there's no gain or loss to record. So we're going to be receiving cash, debiting cash, and removing the asset and accumulated depreciation. So we're debiting cash for the $3,000 cash we're receiving. We're debiting accumulated depreciation for the $13,000 total that we calculated. And we're removing the equipment for the cost that we had, $16,000. So we want to make sure our debits and our entry, we're debiting cash for the amount of cash we received, which is $7,000. We're removing that accumulated depreciation for equipment for $13,000. We're removing the equipment for $6,000, and the amount of the gain is going to be $4,000. The gain is calculated by taking the cash received minus book value. If it's higher, it's a gain. If it's lower, it's a loss. This one was above book value. We got more cash than book value, so we sold it above book value. So we had a gain on the disposal of equipment. Let's look at one where we're selling it below the book value. What does that look like? So the example they give, same scenario, but this time instead of getting $7,000 for the sale, we're only getting $2,500. So we have the same factors in the beginning. We bring it up to date. We have a $3,000 book value. We're getting $2,500 as our cash. So we have a $500 loss. So we're debiting cash for the $2,500 that we're actually selling it for. We're removing that accumulated depreciation for $13,000. We have a loss of $500, the difference between the book value and the cash we're receiving. It's less than, so it's a loss. So we're going to debit loss on disposal of equipment, and then we're going to finally credit equipment for $16,000. So you have examples of how to remove the books, whether you discard it, whether it's being sold at the book value, above book, or below book. So these are great examples to refer back to as you need them. All right, so this is where we're going to stop this video, and we're going to go into the next video, starting out with looking at natural resources. Now, instead of depreciation, we're going to do something called depletion with them. So a little bit different, but you're going to see that it's the same concept as what we saw for units of production with depreciation. So, concept, not new, different wording, but that's about it. So see you in the next video for part 4. Thank you.